And that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin.
I'm sure you've already been told to invest in the S&P 500, let it ride out for 30 years, and you will retire rich. I've told you that as well, right? But here's the truth. I was wrong. At least partially. If you follow that plan, if you consistently invest in only the S&P 500 for the next 30 years, well, you will work until the day you die, because inflation isn't what they tell us, and the S&P 500, yes, the S&P 500, it's just treading water. If you want to actually build wealth, you need to understand some things that most people don't. You need to understand inflation, money supply, and where your money should really go. So stick around, because this could change your entire financial planning and future. Real quick, would appreciate it if you like this video and subscribe to the channel and click that notification bell so you won't miss out on videos like this that will help increase the money in your pocket. You've probably heard that inflation is around 2 to 3% a year, based on something called the Consumer Price Index. This CPI measures the average change over time in prices paid by consumers for a basket of goods and services. It's a common way to gauge inflation, but it doesn't tell the whole story, does it? Inflation isn't just about rising prices, it's also about how much money is being created. And this is tracked by a measure known as M1 and M2 money supply. M1 is all the cash in circulation plus the money in your checking account. This is the money that you can use instantly. Think of it like cash in your wallet or debit card balances. From this graph, you can see that as at September 2024, the value of the M1 supply is approximately 18.15 trillion. But what's more interesting is the growth of this supply. Notice that from 1960 to 2020, the money supply grew steadily, is practically flat. But in the last 4 years, specifically 2020 to 2024, we've seen an explosive growth due to government monetary printing. We went from 4 trillion to 18 trillion. That's a staggering 400% jump in just 4 years. 4 times more money in circulation in the last 4 years than the preceding 60 years combined. Well, that's mind-blowing, don't you think? But that's not all. Let's talk about the M2 money supply for a bit. Remember, the M1 supply includes all the cash in circulation plus the money in your checking account. Well, the M2 includes all of M1, but it also adds the money in your savings account, small time deposits, and money market funds. So this is money that you can access, but it's not as liquid as M1. Again, from this graph, you can see the staggering growth of the M2 in the last 4 years. As of September 2024, the value of the M2 supply is approximately 21.22 trillion. And that's a 233% jump in the last 10 years. And all of this is because the government printed massive amounts of money due to economic challenges like COVID-19 pandemic and debt servicing. How does money printing cause inflation? You see, when government prints more money, it increases the supply of dollars in the economy, that is the M1 and the M2. And here's the problem, more dollars are chasing the same amount of goods and services. Think of it like this. Imagine a pizza with 8 slices and $8 in the economy. Each slice costs $1. Now, imagine that you would double the amount of money in the economy to $16, but keep the same 8 slices of pizza. Now, each slice costs $2. That is inflation. It happens when the value of money drops because there's more of it. Because the government will continue printing money to pay its debt, the M1 and the M2 supply will keep growing. That means inflation will stay high and buying power will shrink over time. Now, let's talk about why investing in the S&P 500 might not be enough to stay ahead of inflation. And if this is making sense so far, let me know by you hitting the like button. Here's what some people don't know. The S&P 500 long-term growth mirrors the growth of the M1 and M2 money supply. Why? Because when more money is printed, businesses receive more dollars. This boosts their revenue, stock prices, and ultimately the index value. But here's the problem. If the S&P 500 is growing at the same rate as the M1 and M2, then it's only keeping up with inflation. Your investment in the S&P 500 are just maintaining the value of your dollars. They are not truly growing your wealth. Let's break it down even further. From 1960 to 2020, the S&P 500 compound annual growth rate, that's the CAGR, was about 10% annually. During that same period, the M1 and M2 grew steadily at similar rates, meaning much of the stock's market growth can be attributed to monetary expansion, not genuine value creation. We talked about how the M1 and M2 grew by 400% and 233% respectively between 2020 and 2024. You want to guess what else grew in the same period? If you guess the S&P 500, then you will be absolutely right. The S&P 500 grew around 15 to 18% annually, which lines up with the rapid increase in money supply. Essentially, the index is just inflating alongside the money supply. And if this continues, then in 30 years, your S&P 500 investment would have only grown on paper, but in terms of purchasing power, you will likely only have what you started with. Because your returns are eaten up by inflation. Why does this matter? Imagine you invested $10,000 in the S&P 500 today. At a 10% annual return, your portfolio would grow about $175,000 in 30 years. Sounds great, right? But if inflation, driven by money supply growth, also averages 10% annually, then that $175,000 would only have the same purchasing power as your $10,000 today. In simple terms, you are not building wealth. You are trading water. You are just keeping up. So, what's the alternative? To truly build wealth, you need investment that outpaces inflation and monetary debasement. This means looking beyond the S&P 500 into other assets. And let's talk about those. So, if the S&P 500 only keeps up with inflation, how can you actually grow your wealth? There are only two investment options that have consistently outpaced inflation and monetary expansion. And no, it's not gold. The first one is Bitcoin. Bitcoin is often referred to as digital gold because it's limited in supply. Only 21 million coins will ever exist. Unlike the US dollars, which can be printed infinitely, Bitcoin is deflationary. This scarcity is why Bitcoin has delivered a staggering growth over the last decade. Bitcoin CAGR, that is the compound annual growth rate from 2013 to 2023, is approximately 95% per year. Compare that with your S&P 500. The S&P 500 CAGR during the same period is around 10% per year. In simple terms, if you had invested $1,000 in Bitcoin 10 years ago, it would be worth millions today, while the same amount invested in the S&P 500 would be worth $2,500. So, why does Bitcoin growth matter? This is because Bitcoin is not tied to monetary policies of any government. When the US prints more dollars, Bitcoin isn't inflated. It becomes more valuable because it's scarce. And here's what this could mean for your portfolio. If Bitcoin continues to grow, even at a reduced CAGR of 50% annually, it could far outpace traditional investment. For example, a $10,000 investment today could grow into $1 million in just a little over 10 years. But Bitcoin isn't without its risk. It's volatile and its future growth depends on adoption and regulatory factors, but the risk has continually reduced as institutions and governments around the world are now recognizing and even adopting Bitcoin. So, for investors looking to outpace inflation, Bitcoin is a compelling option. But hey, start small. Allocate a small portion of your portfolio, like 5 to 10% to Bitcoin. Then you should start dollar cost averaging. Invest a specific or a fixed amount regularly, regardless of the price, to reduce the impact of volatility. And finally, maintain a long-term perspective. Bitcoin prices may drop in the short term, but in the long-term trajectory, it goes up. Now, onto the second investment. The S&P 500 have grown by an impressive 26% year to date in 2024. Sounds amazing, right? But here's the catch. Most of that growth comes from just 7 companies, the Magnificent 7. Apple, Microsoft, Amazon, Google or Alphabet, Meta or Facebook, Tesla, and Nvidia. These 7 companies are like the star players on a sports team, scoring almost all the points, and without them, the S&P 500 performance will drop significantly. In fact, if you remove those 7, the remaining 439 companies of the S&P 500 have collectively seen a year-to-date growth of only 8%, and in some months, it's even negative. So, what does this mean? While the S&P 500 might look like it's booming, it's really just riding on the success of a handful of companies. So instead of investing in the entire S&P 500, which includes hundreds of companies with poor or average return, you could focus on the top performing stocks driving the index growth. For example, Nvidia's stock price increased by an average of 48,000% from 2013 to 2023. Apple and Microsoft has consistently delivered double-digit annual growth thanks to their dominance in the tech sector. But by concentrating your investment in these high-growth companies, you can potentially achieve a far better return than the S&P 500 itself. Just like Bitcoin, there are risks to investing in a specific company. If a single company fails, your investment could drop significantly. For example, if Tesla faces production issues or Apple misses its product expectation, the stock price could tumble significantly. There's also valuation risk because high-growth stocks often have inflated prices and could lead to losses if growth slows. And finally, the obvious lack of diversification. Concentrating in a few stocks leaves you exposed to individual performances. But you can mitigate this risk by 1. Researching thoroughly. Make sure you understand the business model, the competitive advantage, and the growth perspective of each company that you invest in. 2. Limit concentration. Avoid putting all your money into just 1 or 2 companies. Spread it across a few top performers. And number 3, conduct regular reviews. Reassess your portfolio every 6 to 12 months to ensure that these companies are still strong performers. What does Warren Buffett, one of the greatest investors of all time, have to say about this? Well, Warren Buffett has consistently advised that most people would benefit from investing in low-cost index funds like the S&P 500. He stated, "In my view, for most people, the best thing to do is to own the S&P 500 index fund." But here is what many YouTubers advising you to invest in the S&P 500 would tell you. This advice is tailored for the average investor who may not have the time, resources, or expertise to analyze individual stocks. By investing in the S&P 500, you spread your money across 500 of the biggest companies in the US. This makes it safer and easier for someone who doesn't want to learn a lot about finance or the stock market. But here is what Warren Buffett really thinks about the S&P 500 and diversification.
We think diversification, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. And, if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own.
Did you hear it? Diversification is a protection against ignorance. It makes very little sense for those who know what they are doing. Do you know what you are doing? So what does this mean exactly? If you take the time to learn how to pick good investments, good businesses, you don't need to spread your money across hundreds of stocks like the S&P 500. Instead, you can focus on a few great ones and grow your wealth faster. Here's the bottom line. Buffett's advice about investing in the S&P 500 is great for most people who don't have the time or knowledge to dive into investing. But if you want to do even better, start learning about money and how investment works. The more you know, the more you can grow your wealth. If you don't want to learn about money, you don't want to learn about finance, then stick to index fund. Otherwise, you are going to get burnt. So, how would I build a portfolio today? And remember guys, none of this is financial advice. This is what I am doing, and I'm not recommending that you do the same. Your goals are not my goals. I'm just giving you stuff to think about. Your circumstances might be different from mine. You might be planning a retirement soon, or expecting a baby, or some other life event. But for me, as someone in his 30s, recently married, no kids, no debts, and stable income, this is how I will structure a portfolio that balances growth and risk. Number 1, I put 30% in individual stocks. High quality stocks like Apple, Microsoft, Nvidia, MicroStrategy. Number 2, I put 50% in alternative growth investment like Bitcoin and other cryptocurrencies. And this also includes Bitcoin proxies like MicroStrategy and Bitcoin miners. And thirdly, I'm going to have 20% as a safety net. This 20% will involve cash and S&P 500 for market stabilities and downturns. Remember that both Bitcoin and individual stocks require research and patience. Don't just jump in blind, start small, begin with small amounts you can afford to lose, especially in volatile assets like Bitcoin, but stay consistent. Whether it's investing in Bitcoin or top stocks, use strategies like dollar cost averaging to minimize your risk. And if you find this video helpful, hit that like button and subscribe to the channel and turn on that notification so you don't miss more content like this. And what are your thoughts on Bitcoin versus the S&P 500? Do let me know in the comments. And if you think that inflation is bad, wait until you hear about how the US dollar is losing its global power. That video is coming up right now.